In the fast-paced world of mega real estate projects, being well-capitalized, well-connected, having a keen eye for value creation, and a stomach for risk will only get your foot in the door. You work hard for your money. It's time to let your money work just as hard for you. Hi, welcome everyone. Thank you for joining us. My name is Joe Berko, and I'll spend the next half an hour or so talking to you about ways to leverage institutional quality real estate in order to build your wealth. I'll also take the opportunity to talk a little bit about myself, talk about the company. We'll explore some ideas about what's in store for investments, how to maybe give some planning for retirement, and how real estate can be helpful as part of a healthy and diversified portfolio. And we'll leave a few moments towards the back end to ask some questions. There is a raise hand at the bottom of your screen, so if you want to stop and ask questions, feel free to do so. A Charles Schwab survey from 2020 found that the average 401k participants think they'll need about $1.9 million to retire. Now, I'm going to make a wild guess here, and I'm going to assume that not everyone here in this conversation is sitting on a hefty amount of $2 million. However, if you're serious about investments, if you're serious about investing and making sure that your future looks comfortable and cozy, then implementing a well thought out plan early on, whether it is you're in your 20s, whether it is you're in your 30s, 40s, 50s, 60s, whichever it is, you can build a really nice nest egg that can take you comfortably into your retirement years. The true reality is most people throughout the United States are simply not investing enough. While they have lofty goals and why we all want to maintain our lifestyle and the way that we're accustomed to live life, and we want to travel and we want to be with our family and we want to have great things and buy, we don't put enough aside. So that's the harsh reality. Investing smartly will allow you to take a smaller portion and build it over time if the capital is placed in the right possible way. So one of the challenges we're facing now is the I word, inflation. We haven't seen this level of inflation in nearly 40 years. Right now, we're at a 7% inflation rate. Some are saying 8%. Certainly, inflation is that erosion of our savings, erosion of our capital. Our purchasing power is being affected. Those of us in the conversation here that have been around in the 80s, remember double-digit inflation. It was quite a nasty, nasty period of time. And certainly hope we're not going to reach those levels. But taking that into account, we have to find a little bit better way than putting our money in the bank or putting it in a CD account. It gives us a fraction of a percent a year, because more so than ever before, at a rate of a 7 or 8% inflation rate, we need to find a reasonable vehicle that will push our investment forward. And I think we have some pretty interesting points to raise here. So if you were to sit now comfortably with, let's say, $1 million in your bank account and have done absolutely nothing, and rate of inflation would have been kicking it around at 2%, erosion of capital is absolute happening. Of course, it kicks quicker if it's at 4%. And you can see by this graph, if you were to do absolutely nothing with your capital, just inflation alone will take away your purchasing power by a very, very dramatic amount. We all know that real estate is a great hedge against inflation. It's been said and been addressed in multiple different ways. And some of the ways it is a hedge against inflation is because the leases that are attached to commercial real estate, institutional real estate, whether it is a commercial lease, whether it is a retail lease, typically have a growth rate that goes along with it. So there's some hedges that can help us stay ahead of the curve. The other thing that's important to note, not always mentioned, is that while your mortgage is fixed, inflation actually helps your mortgage payments, because while they stay fixed over a long period of time, the absolute value and the absolute cost in inflationary terms actually means that you're paying less every year. If we look at a real estate investments, and if you were investing in, let's say, in a REIT, a real estate investment trust, you would have been having for the last 20 years, if you start in the year 2000, for the last 20 years, 21 years, you would have been averaging around 13.7% return. If your money was at the S&P 500, diversified throughout the stock market, your average with the fluctuations, with the ups and downs, would have been around 7.3% return. We're going to take a look at a few other options as well. Well, the good news about what we're talking about today, which is obviously focused on real estate, is that 90% of millionaires have achieved that status through investing in real estate. It's not a shocking statement. Many of you are fully aware of it. But let's take a look at today's agenda. So we're going to be talking about passive income, all forms of passive income, and specifically focusing on real estate. So before we dive deep into what it is, passive income, and how real estate and investment for retirement is going to look for us if we were to blend into our portfolio a good amount of our capital into, let's say, private equity firm like ourselves, let me share with you a couple of words about myself. So I've been in the real estate arena for the last 26 years. I started in New York City as a commercial real estate advisor and broker. I've been an advisor for the state of New York for the last 9 years. It's a governor nominated position, which is quite interesting. I've been an advisor for a number of public companies, a number of pension funds, family offices, high net worth individuals, and so on. A lot of my focus has been helping companies mainly focus on large scale transactions in hundreds of millions of dollars. I've also been instrumental in raising capital for public companies overseas, and been doing it for quite some time. Over the years, I have shifted my focus and moved away from the advisory side of the business into the private equity side of the business. So basically I said, look, if the advice that I give is doing well for my clients, why not offer the very same advice to myself? So I put my money where my mouth is, teamed up with Michael Corrine, my partner. We've been working together for the last 11 years or maybe a little bit more. And we've shifted our focus. So from our company that was focused on advisory work in New York City, we've expanded to 3 different markets. We're now sitting in Miami, New York, and Phoenix, Arizona. We currently, as a group, participating in well over $2 billion in real estate in 7 different states and 12 different markets, and growing quite exponentially. But let's go back to passive income, the focus of this conversation. So investing in private real estate for potentially for your retirement, maybe getting a few people uncomfortable with the word retirement, but I do want you to get into the habit of thinking long-term. Okay, real estate is long-term, investing is long-term. So what's an SWR, the safe withdrawal rate? Assume that your safe withdrawal rate is essentially a calculation of how much a retirement or a retiree should be comfortably drawing from their accumulated assets without running out of money, right? We're all working right now. We're doing well for ourselves and for our families. Cash flows coming in. We have a stream of income through the work that we do, through the professions that we are choosing. But there's a source of income, the passive source of income, it's sort of like they're working along with us and would allow us to build the nest egg that we're looking for. And so, most economists, most financial advisors will tell you that, you should be pulling about 4% of your nest eggs to make it financially viable. Okay, so what does it really look like? If you were sitting on the side with $500,000, the comfortable withdrawal rate at 4% basically means that you can draw from your retirement account about $20,000 a year. I know that for a lot of people, $20,000 just simply not going to cut it. $2 million at a 4% rate essentially will give you $80,000 a year. Probably feels a little bit more comfortable, but how do we even reach $2 million? If I'm a 35 or 40-year-old individual right now, working hard, putting a little bit of money on the side, how am I able to create such a tremendous amount of capital, and what's the right way to do it? So let's take a look. According to the Wall Street Journal, the optimal mix in a portfolio is about 50% real estate, 30% in stocks, and 20% in bonds. So we have the illiquid assets. We got real estate, and that could be real estate investment trust, REITs. It could be private equity like our company. It could be simply buying real estate and managing real estate on your own. 30% in stocks, which means you have a good amount of liquidity. You're able to weather the storm if stock market takes a hit and goes down, and sometimes it does. Every 10, 12 years, we see a drop of about 30 to 40%. If you don't have to sell, don't. But eventually, as we saw, if you've been investing in the S&P 500, you're somewhere above the 7% annual return. The bond market has averaged about 5.5% return on average right now. If you look at the bond markets, priced at around 2.5%, but an overall average, we're looking at about 5.5%. So you got the conservative, you got the kind of like the volatile, but very liquid, and then you got the illiquid real estate that tend to be doing fairly well. So if we were to say we have $100,000, if we look at this example, if we had $100,000 and we've invested in a REIT, okay, and let's assume every 3 years we wanted to see what sort of annual return we will be having. The market average for REITs is about 13.7%. So I'm doing a little bit better, others doing a lot worse. But if you chose the right real estate investment trust, that's the average. Bonds, on the other hand, are about 5.5%. S&P, as I mentioned, 7.34. Where we stay in this game is on average today at 23.1%, 23.1%. Looking forward into our projected investments, some of those numbers are even higher. Now, when I'm referring to 23.1%, I'm referring to deals that we've already invested in, some of those that we've already returned to our investors. This is where we're averaging today after we had our investor paid our fees and paid the promotes and all those different things. A very nicely balanced portfolio will actually allow an investor to average around 13.4% return without having exposure to one market. Diversification is extremely important in the investment game. You certainly don't want to put all your nest eggs into one bucket and one bucket alone. You want to create a very nice diversified portfolio. But if you were, for example, and we've highlighted Astor Return, okay, in the green borders, if you were to invest $100,000 today over the course of 21 years, providing we stay with the same growth rate of 23.1% per annum, and every 3 years we're able to recycle money, and we'll talk more about the way that we're doing it because we are focused on short-term investments, then you're looking into some pretty hefty returns, 21 years down the line, almost close to $4 million. Now, a little bit of a side note. Am I saying that every year and every investment, we're going to be able to create a 23.1%? No, I'm expecting that there's going to be some tough years. Not everything is paved in gold. But we do have a very, very solid track record. And this is according to our numbers today, going back last 7+ years. This is our average return. And keep in mind, we went through some very tough period of time, 2020 and pandemics and so on. And so this is just an example of what it would look like a nice balanced portfolio. One thing I highly recommend, in the previous example, we showed a growth of how we are able to invest capital and achieve pretty substantial returns. One of the things I highly recommend is to explore the option of an IRA, invest in a self-directed IRA. You can invest as much as $58,000 or $60,000 on an annual, any given year. Their capital is invested. When the return of capital, once the investment is finished, the return of capital is not taxed so long that you don't pull your money back from your IRA. We can talk more about this. We can actually have a conversation with IRAs that we're working with. Effectively, those are very smart retirement accounts. This is money that is set aside that allows you to invest in to your future. Essentially, the taxes are deferred, and so you can keep on rolling it and keep on growing your retirement. What's unique about us, or what's different about us potentially, is other than, I think we're highly experienced, and not everyone's in the market in the private equity space is highly experienced. Some are great experience, but it's really technology-based experience. We are actually coming from the world of real estate with a collective experience of about 60 years. We offer institutional capital. In fact, we are institutionally backed, which means the partnership that we've created is with a publicly traded company. We have access to very large amounts of capital. But from the very beginning, the way that we've conducted our business is to ensure that a portion of the capital that we invest is A, our own, and B, allows our friends and family to participate. Of course, over the years, the circle of friends and family have grew, and friends brought other friends with them, and family members brought other family members with them, and so we're growing quite exponentially. What I think is important to us is preservation of capital. When we're investing in real estate, the first and foremost important element is, can we preserve capital? We all work extremely hard for our money. You work very hard for your money, so do we. The last thing we want is to see in any situation that money is lost, investment is lost, capital is lost. Preservation of capital for us means that we will not go into any investment opportunity without knowing how we're coming out of it. Now, market conditions can change and cycles can come and go. But at the core of our underwriting, if we don't know to take the worst case scenario in any investment opportunity, and at the very least preserve our capital, then we will not enter that investment. And it typically means something as simple as the following, which not a lot of people do. You're investing in an apartment building, building a 300-unit apartment building, which is similar to a lot of the investments that we do. At the business plan, we're expecting to sell the asset sometime between the 2.5 to 3 year mark from the beginning of our investments, and kind of like hit the peak of the return and do the distribution to our investors and recycle the capital into the next investment scenario. In the event that market conditions are not right to sell the property, what we will test is to see if we're able to refinance the asset, keep it fully leased, and enjoy some of the cash flow, even if it's very minimal. But are we able to refinance the existing construction loan? So that's one area, one example where preservation of capital comes to mind. Alignment of interest. Our capital goes into the very same bucket as each and every one of our investors. We take the exact amount of risk. Alignment of interest means that when we are pulling capital together, it's our capital along with our investors, and we're essentially a unit operating really side vehicle to our partners, our developing partners. So what we do is essentially we operate in markets where we have depth of knowledge and experience. We pick and choose the kind of partners that we know that with them we can build an amazing project, that we can do it on time, can do it on budget, folks that have deep pockets, folks that have very deep experience and great reputation. But consider that a developer or developer partner essentially is operating on multiple assets. So who's there to really watch our money? Who's there to really make sure that some of that capital doesn't actually go to another development site that has nothing to do with us? That's a big, big part of what we do here. So the alignment of interest is extremely important to us. We team together as a group. You have us as managers with all the experience that we have, with the multiple offices, with the analyst, with the asset management, and that's how we conduct the show. We make sure that our partner, the one who manages the day-to-day, is actually doing the right thing at the right time. Not always the case with many development or with many investment opportunities and very many investment platforms. Ongoing asset management essentially answer that question. We have folks on site making sure that our partner, the developing partner, is actually doing what he's supposed to be doing on time and on budget. Above market returns, yes, we do. 23% is considered to be above market returns. We certainly are doing better than the S&P. We've established that. We're certainly doing better than what REITs are doing. We certainly don't have those very heavy fees that a lot of companies take. Our structure is fairly simple. We collect capital from our investors. We offer 8% per year as a minimum hurdle, and above the 8%, we start splitting the profits on a 75 to the investors, 25 to us. And because we're able to collectively bargain with the developers that are out there on a day-to-day, essentially we are creating better return because of that collective bargaining. The personal approach, I think, is extremely important. Essentially, there's a lot of platforms today that folks can click here and click there and electronically sign here and send your money, and we'll send you an occasional report. That's not us. You're dealing with real individuals with real experience. We're not technology guys. We're real estate folks with boots on the ground. We're checking, we're analyzing, and we're making sure that the information that is available to us is available to you. And quite frankly, we're very proud with the amount of years of operation. We have absolutely zero losses to date, In the worst possible time, I think our worst performer still created a 6% return per annum. And that was during the 2008-2009, where people were handing back the keys to the bank and saying goodbye to their properties. We were operating and we were able to A, preserve capital, and B, do fairly decent. When prices were going down in the market, we call it, there was blood in the street, we were still doing really well. So just to reiterate, 60 years of collective experience. We're investing in major markets, institutional level type of properties. We have about 1.96 billion in participation, real estate participation. We're managing today about $160 million on our books and growing, over 2,400 units, very high-end units for the most part, and 3.4 million square feet in various stages coming out of the ground, fully stabilized, exited, and so on. Our portfolio is extended from Columbus, Ohio to Arizona, Dallas, Tampa. We really are in very, very major markets. We always look for very unique pockets where there's high growth rate of employment and population, where the income levels are really high, where the demand is very, very strong. We always follow the demand. Those tend to have kind of like the biggest impact. Equilibrium between demand and supply will always win, even in areas and times where the economy might be slower or might be inflationary environment or anything of that nature. Or right now, like we're facing an increase in interest rate, we'll always go after markets with very, very strong demand. And again, our formula works. I think we've covered enough about the function of passive income. But eventually, keep in mind that we always want to see diversification in folks' portfolios. So not just diversification within the various different food groups between the bonds and the stocks and the REITs and the private equity. We also want to see diversification in our investors within the portfolio that we use. So typically, if an investor shows up and says, hey, I have $100,000 to invest, we'll immediately recommend the following. Let's chop it up to about 4 different investments and create a little bit of a diversification for you. It gives a level of comfort for everyone. It's always nice to be in that position because we have low startup capital compared to traditional real estate investments. We have, as I mentioned, institutional grade investment properties. So you're not kind of like investing in fixer uppers and all kind of tertiary markets. These are solid location. Location does play a very major role when it comes down to real estate. Don't have to deal with the upkeep and the maintenance and getting the phone call at 2 o'clock in the morning. Hey, I have a flood and my bathroom doesn't work. Being that kind of a landlord. To some it's fun. I've tried it for a good amount of years. I can tell you, I much rather have a professional management company right next to me to deal with those situations. It's important to note that none of our investors, of course, are exposed to anything that has to do with taking on the loans or signing on our mortgages or anything that can be detrimental to their nest egg. And obviously there's no personal or any guarantees that any of our investors are required to sign. Market cycle. Market cycles, I want to say, we've been operating for many, many years in New York City, one of the most competitive markets, probably most competitive market in the world. Things are moving quick. Properties are changing hands, value goes up, and it's a very, very dynamic market. And we have learned to create capital to make returns when the market is doing great. And when the market is actually slower, there's always opportunities in real estate. Robert Kiyosaki, Rich Dad, Poor Dad. It's a fun book for those of you. I'll be surprised if somebody here on this call have not heard about this book. Very, very simple to understand. And I like his quote because it says, real estate investing, even on a very small scale, remains a tried and true means of building individuals' cash flow and wealth. So I'd like to touch on a couple of questions that came up here. For example, the first one is, how is investing with Astor different than investing directly with a developer? Investing with Astor is different. I think I've touched it several moments ago, but investing with Astor is different than directly investing with a developer because of the reason that I've mentioned. Typically, developers will show up with a project, could be a very nice project, and will raise capital either through institutional groups or through small amounts. We represent both. We have a partnership with an institutional group that's backing the major backer of our investments, and of course, our club of friends and family, which has at this point probably over 120 investors. And growing slowly. We don't have much need of capital, but it's our mission. Essentially, working with a developer means that you'll come in with a small amount, most likely, maybe 100, maybe a couple of 100,000. And the reports that you'll be getting from the developer, there'll be nobody there to verify that the information is true and accurate. If there's going to be some changes to the budget, there's really, other than listening to the developer himself, there's really nobody else that can actually tell you, yes, it's true, or no, it's not. If there's delays, if there's any sort of variations from the business plan, there's nobody there to represent you. Investing with Astor is phenomenally different, is significantly different, because we, while creating a joint venture with the developer, our partnership Okay, our partnership is us. It's us as a collective. So the first thing that happens is the structure that we create, the legalities that we create, give the developer the feeling that, first of all, in the event that he will stray away from the project, if he will move money away in the wrong way or do any bad act, we'll have the capacity to remove the developer from that position. And so that's kind of like a very big sword. There is a professional team that is your partner, that is sitting with you, representing your interest, and working with the developer, making sure that they do the right thing. It doesn't always lend right, so I'll say it differently. We don't control the money. While we collect the capital and collectively invest the capital, the only group that is spending money and building the project is the developer. We say the developer manages the day-to-day. We control and manage the month-to-month. So we are focused on the asset management, right? Well, we're not going to go in and say you should put a yellow tile here and put and change the fridge over there. We are going to make sure that whatever budget we've agreed upon is going to stay intact. And we have a mechanism to make sure that for the following 2.5, 3 year, or even longer, sometimes our development tend to get a little bit longer, maybe 3.5 years. There is somebody that's actually watching everything that goes on and collectively collect the information and reports to our investors. So it's very different than investing directly with any developing group. As great as they may be, it's still very different. We are creating the alignment of interest. And of course, our money, my partner's money, my wife's money, our family money, our friends and family is invested alongside and has the exact same exposure to the same risk. Summing up what I was saying before, we're very different than crowdfunding. Crowdfunding is there to technologically, electronically collect your money, offer it to a developer, and make sure that they get their fees. There's nobody's watching your investments. There is no mechanism. You're essentially exposed to whatever the developer is telling you, whatever the information you get. Nobody's there to verify. We are very, very different. First of all, it's a very personal thing for us. Our investor knows us directly. They can reach us. They can have questions and everything else that goes along with it. But the most important thing, you have a partner that is invested alongside you that have the same amount of interest to make sure that things will go along properly. I had a question here. How can we get a copy? A copy will be sent to everyone that's participating on this. I'd like to say the first time that we're doing a Zoom like this, we typically are pitching to our investors. However, there's many individuals here that we're not familiar with. And so the first stage is for us to introduce you to Astor Realty Capital and the way that we're doing things. What are the typical fees? This is from Irish Kevin. The typical fees that we charge every investor is participating in a 5% fee alongside the investment. So if you've invested $100,000, there's also a $5,000 fees. Those fees are there to help us keep the lights on, as we say. We have salaries, we have people that are checking the project, and so on. There's some fees that we're getting directly from the project. Everything is disclosed. And eventually at the back end, when you receive your money back, plus a minimum hurdle of an 8% per year, over the 8% a year, then we start participating with you in some of the profits. And yes, we'll be happy to send a recording. The other thing that we'll send is our company marketing brochure as well. Let me see if there's a typical syndication deal or other vehicle. Not quite sure what's a typical syndication deal, but the way that we raise capital is your essential position in the deal is in proportion to the amount that you've invested. So for example, if we were to raise will be 10%. Once you get your capital back plus a return, then the capital that's owed to you will be based on 10%, and that will be the area where we're going to start participating in the profits. How much money do I need to invest in our deals? I'm going to say that the minimum amount for us is usually $25,000. Sometimes it's a little bit more than that. But we found over the years of operation a couple of things. We're less concerned about the amounts. We usually oversubscribe within a day or so to every investment opportunity. As I mentioned earlier, we are institutionally backed, so we have our main investor is a public company. So shortage of capital is, thank God, knock on wood, not an issue. However, part of our business plan is to include and have access to our high net worth. So typically it's $25,000. That's sort of like the minimum. And it grows from there. Do we have an investor web portal? Yes, we do. Each and every one of our investor, when they are interested in one of the investment opportunity, receives, and first of all, we create their own portal. All the due diligence that we have access to, all the information that we collect before signing on a deal is available, including all the legalities, all the legal documents, including if this is a purchase, the joint venture agreements that we have with our developing partner, the agreement that Astor has with its own investors, any piece of documents and any ongoing documents, because you are receiving quarterly reports from us that are verified, boots on the ground, as I mentioned. All this information is available in your investor portal. It's your own password. And we have Laura and others that are there to help you maneuver through this and so on. We obviously offer K1s on an annual basis to each investor. And that's how we are operating. How is money protected? First of all, money is protected in several different ways. When we are collecting money, when we are at the raise mode, we do it through a third party. Typically, we use Truist Bank. It's I think, a $23 billion bank that has an escrow account for us. So I don't have access to the money that we're raising. My partners don't have access to the money that we're raising, and none of our employees. All the information, all the capital goes into that account with specific instruction when the money is raised and all the documents have been signed. The capital goes into the entity that will hold the property. On the return of capital, when we're distributing money back, the exact same process occurs. Money goes into the escrow account with specific deviation, who's entitled to what, based on the amount that they've invested, and of course, based on their returns. A very good question. Do we have cash flow? Yes, and occasionally we do have cash flow investment opportunities. While we like the hyper returns, another good reason why most of the returns that we're able to achieve are above 20% per annum. We do have cash flowing opportunities as well, whether it is a value add multifamily complex. We recently closed 205 unit complex located in Texas, in Arlington. Sometimes we create all sorts of positions that are considered as preferred position that are paying a certain amount of cash flows. So we typically conduct about 12 transactions a year, and our investors obviously have access to the information about those transactions. We do a webinar similar to this. Only the internet works better when we do that. Everybody gets the opportunity to learn about the investment, to ask questions, to go through the documents, and to make a determination if they choose to invest with us or not. Roughly every 45 days, or so, every couple of months, we sign a deal, or sometimes a couple of deals that we show up to the table with. We're averaging around 10 to 12 transactions a year. Okay, so what kind of investments Astor invests in? Astor invests in essentially mainly ground up project, institutional project. The partners that we choose to build those assets on average probably have about 25, 30 years of experience in the very same market that they operate in. We tend to keep those fairly short. We enter when, for the most part, when we're fully entitled and ready to start construction. A lot of times we enter right together with the construction lenders. We love investments where we have a very clear entry, a very, very clear exit, where we can replace capital, return the money back to our investors with the profits, and offer them the next opportunities. In terms of, are these a 506c offerings? The offerings that we have are essentially available for accredited and non-accredited investors. We typically have no more than 10, sometimes 12 investors in each and every one of our syndications. As I mentioned earlier, the majority of the capital, 80% of the capital that we invest, we pull in from one source, a institutional group, and then we leave a certain amount, usually not a big amount, but a certain amount that we allow friends and family and other investors that are following us to participate as well. This is where we started. This is really what gives us the warm and fuzzy. When we're able to work hard, put all our senses together, put together a great deal, a creative deal that allows ourselves to make capital, to our investors to make capital. And you know what? One of the biggest rewards, and I'm not going to say that the money that we make from the work that we do is not a great reward. It's an amazing reward. But one of the biggest rewards is to see that our investors are happy and are coming back for more. So I think that it certainly gives us the biggest level of satisfaction. With that in mind, I want to thank you all for participating, and I'll have the office reach out to you and allow you to have this presentation. Of course, some information about Astor Realty Capital, and I hope to see you in our coming investments. Thank you very much, everyone. Enjoy the evening and take care. In the fast-paced world of mega real estate projects, being well-capitalized, well-connected, having a keen eye for value creation, and a stomach for risk will only get your foot in the door. You work hard for your money. It's time to let your money work just as hard for you.